Hey guys, welcome to our financial future. This channel is designed to build a community of investors so we can all grow together and build our wealth. So if you have any questions or concerns or comments, leave them down below and I'll try to get back to you. In this video, we're going to go over what is a portfolio and the types of risk we will see, the type of risk we will see with certain companies we want to invest in based on their size, and we'll even get into some ETFs and their characteristics. So let's get into this. When we look at our portfolio, we want to view it as a basket of our holdings. Now this can include stocks, bonds, and mutual funds. The way you want to view your holdings is how you are exposing yourself to the market. And let's say you were confident at driving, feel less riskier when you get into your car. But if you weren't good at driving, then you would feel that you are at risk of getting into an accident. And you want to look at it that you are the driver of your portfolio, and the more confident you can get, the less riskier it is. There are going to be different types of stocks or bonds or mutual funds that we come across, and we're really going to have to evaluate these things based on the risk. And when we become good investors, we will be able to determine what that risk is. The first type of company we're going to look at is a blue chip stock. And these types of companies have been around for a really long time and usually are very predictable and stable in their nature. Sometimes they offer a dividend, but usually they're going to be common names that you've heard of. Next, we have growth stocks. And growth stocks are more of a medium to high risk type of investment that we might come across. They can differ from blue chip stocks as their revenue might not be as consistent or predictable. They also might carry a little bit more debt than others and might not be profitable. So we will have to become good investors to be able to evaluate the risk when adding them to our portfolio. As a young investor, you might come across something called a penny stock. And these things are very risky and belong in a place where a more mature investor should be looking at. Now, penny stocks are also very hard to trade because not everybody wants to buy them and carry a large amount of risk in doing so. A good example of a blue chip stock could be something like a Johnson & Johnson, who has been around for a very long time and has very predictable earnings because the products they sell are very consistent on what people want. A good example of a growth company would be something like a Tesla, where their earnings are very unpredictable because it's hard to understand how many people are actually going out and buying these cars and how they are turning a profit. So when picking our stocks and equities, we really want to be able to determine the risks that we are actually comfortable with by using the knowledge that we have. And if you do not gain the knowledge, you won't know your risk and you'll probably be taking more risk than you actually should be. When it comes time to pick stocks and equities for our portfolio, one thing that has to come to mind is the time frame that we have. If we are a young investor with a long time frame, then we have time to take more risk and possibly lose money and recover from it. Whereas an older investor will not have that type of time to recover if he does make a mistake. When it comes to weighting our portfolio, there is actually room for saving cash in there. Cash can be a hedge against a downturn, but it also can be used in a time when a equity falls and it is a good buying opportunity. So we always want to have a little bit of cash on hand in case something like that happens. Here is an example of what a portfolio could look like. You could have 70% invested in more companies like blue chip stocks, which would be less risky. And then your other 20% would be more towards growth. This would be a portfolio for someone who is much older or who does not feel like taking much risk. We want to look at our portfolio as one big unit of risk with other smaller risks inside of it. And when we want to divvy up our equities, we will decide based on the whole amount that our portfolio is worth. If we are going to put more riskier investments in there, we have to weight it against the less riskier investments. For example, in this portfolio's case, if we had $10,000, we would want to take 70% of that, which would be $7,000, and invest it into the lower riskier part. And the more riskier part would be $2,000 of those dollars. This type of portfolio would be for an investor who wants to take a very low amount of risk. But this could also be for an investor who has a shorter time frame and doesn't want to take that chance. Someone who has a longer time frame and has more knowledge in the stock market, they can be much more confident about the risk that they can take. So they're going to be able to design a portfolio that is more riskier, but to them, that risk might not be as much as to someone who has a less time frame. As you become a more skilled investor, you will be able to determine what type of risk you are able to take based on your time frame and how confident you are at gaining knowledge to prepare yourself when you want to deploy your capital. If you find this video helpful, hit the like and subscribe button so you can get future videos. This will also help the YouTube algorithm deliver this video to someone just like you who is trying to learn to invest. Now that we know more about overall risk, let's dive deeper into a little bit more specific things. Even investments like mutual funds, bonds, stocks, and even the size of the company in an ETF all have different types of risk characteristics when we want to add them to our portfolio. When it comes to stocks, these companies are all different sizes, and usually the smaller ones are the ones that are a little bit more riskier because it's very uncertain what their future looks like. Generally, these companies are called small caps, and they range from the price of 300 million to 2 billion in market cap. We also have mid-cap companies. These companies' market capitalization is from 2 billion to 10 billion. Now, these companies still offer a good amount of risk, and that's because they are usually in a competitive field. We are also able to make good gains off these types of companies if we are able to do our research and guess right. We also have large cap companies. Their market capitalization is 10 billion or over. These companies are generally more stable and have been around for a long time. They also usually pay a dividend, and we can use these companies in our portfolio to be able to mitigate risk against growth companies. We also have mutual funds, and mutual funds are a low risk investment. The way you want to look at mutual funds, it's technically a portfolio that could be up to 1,000 stocks, and usually these are picked by professionals. And these are a great way for a beginner to start investing as he learns to become a better investor. There are also bonds. And the way you want to look at bonds is when you go take a loan from a bank, you pay a certain percentage. Now, instead of you going into debt, the company you are buying the bond from is going to debt, and they are borrowing the money from you and paying you that interest rate, which is usually paid on a yearly basis. Bonds are a very safe investment as these bigger corporations usually tend to pay off their debt. You can also get a government bond, which the government is also reliable at paying off their debt. So these are very good investment tools for beginners or older people because they are very predictable in their returns. We want to pick something that really suits our investment needs, and we really need to get diversification as well. Not only just diversification in numbers, but in the types of companies we invest in as well. As a young investor, you want to find a low risk way of getting into the market. Staying out of the market doesn't give you the experience you need, and you need to experience the fluctuations in the market so you can feel those emotions and be comfortable with them when it comes time to buy more and more stocks. I actually remember the first time I bought a stock, and it was actually kind of funny because I really couldn't handle the volatility in the market. I couldn't handle the idea of actually losing money. So when I bought the stock, I actually sold it two weeks later. It did go up 20%, but then I learned that I actually needed to be in the market to become a better investor. An index fund or an ETF can be a great place for a young investor to get in, but eventually you will want to become a more experienced investor and not have to be able to rely on these vehicles anymore because you will be able to evaluate companies over time and become better and better at this. Essentially, what an index fund or what it does is that it tracks an index like the S&P 500, which is the 500 largest companies on the United States Stock Exchange. An ETF is very similar to an index fund, that it can be exchanged on the market like a stock. These ETFs usually track a certain sector or a certain theme to these that you will have to actually go in and see what is inside these ETFs before you actually purchase them so you can make a good decision. ETF stands for Exchange Traded Fund. These things usually track a specific sector, something like maybe gold or silver or maybe some agriculture or maybe even healthcare or banks, or they could even track commodities like grain or corn. So ETFs can have a place in our portfolio as they are a way to diversify, and diversifying can lower our risk, and there is a proper way to do that. And as you become a more experienced investor, you will find different ways in your own style to diversify properly. When we do decide as a more experienced investor, we might move away from these index funds and ETFs and want to come to pick our own stocks. But there is going to be a risk in picking stocks, as we might like certain sectors. And generally, these sectors move as a unit when these companies go up and down. So that is a type of risk that we are going to have to watch out for, and not just piling all in one sector. A really good quote to reference this is, "A rising tide lifts all boats." And the same thing can happen when the tide goes down. So what this is referring to is, if solar companies are doing very well, they will bring up the other solar companies. But if they are going down, they will all come down together. Throughout your life as an investor, you're going to be constantly changing your portfolio. So this will require a decent amount of attention when you decide to move stocks in and out of it. In this video, we took a look at how we view our entire portfolio as a risk. We viewed how we spread our money out in our portfolio as a risk. We even viewed the size of companies as the possible risk, all the way down to diversification, and even down to sectors have a certain risk when we want to invest in them. If you enjoyed this video, hit the like and subscribe button if you want to get more updates. If you have any questions or comments, please add them below and I will do my best to get back to you. Thanks for stopping by and have a great day.